To what extent is infrastructure insulated from the wider liquidity crisis, do you think, Olivier?
I mean, I don't think it's insulated. I think it's at the moment it's largely remote, especially because, I mean, coming back to the way infrastructure is financed, because of everything we explained, the sort of natural way to fund infrastructure assets would be long-term amortizing debt. So you don't take any liquidity, you don't take any interest rate risk, any market risk. Basically, it didn't went this way. It didn't go this way in the recent past, and we've seen a lot, especially again for these acquisitions finance, a lot of LBO type, 7 years bullet debt with a lot of refinancing risk. If these deals were coming to refinancing now, it would be a real disaster. It would be a real disaster essentially for the bankers, because this debt is, in the vast majority held by banks, and I think banks would have no other option than sitting on their exposure and waiting for the cash flow to come in, better time to refinance or loan to amortize. And I think the good thing with infrastructure assets, you can do that because you still have cash flow flowing in anyway, so you can be current on your interest and start building some amortization. That said, most of these transactions have been done in the last 24, 30 months. Refinancing period is more beyond 2010, 11, 12. So there is no specific risk at the moment on this type of transactions. There will be if in 2011 the asset have not generated gross. Interest rate have moved up, credit spread have moved up, then there may be some seesaw effect. And again, in theory, the equity should take the pain. In practice, I frankly believe the banks will have to take the pain at this time.
I think this is a really quite an interesting question, again, it comes back to the point about how have you financed this. How much have you paid for it? And just taking a UK example, some of the recent utility transactions that have gone through are very expensive. The regulator sort of gives you a clue about how you should value a utility in terms of giving you its regulated asset value. And if you're paying a 50% premium to the regulated asset value, that sort of gives you a clue that that's quite expensive. And you've got to fund that. You've got to fund that with debt. And the point about a regulated utility is that the regulator regulates it. That's why it's called a regulated utility. It's a bit of a clue. And then at the end of every 5 years, the regulator will sit down with you and he'll say, let's have a little chat about how much you're going to earn on this regulated utility, and let's look at how risky these cash flows are, and let's determine what the cash flows are going forward. And he will take a view on the premiums that people pay for these utilities, because it's arguable that assets shouldn't trade at 50% premium to their regulated asset base. So if you've got a financing in place and that financing requires refinancing, and you've got a price control review coming up every 5 years, you need to think very hard about the level of debt that you're putting into that company to make sure you can manage that refinancing risk at that point.
But the only reason why you see 30, 40, 50% premium to regulated asset value is because there is financing, right? It's purely financial engineering. It's the disconnect between the actual leverage and the target leverage that the regulators have, and also,
Yeah, I mean, you've got a very interesting market in the UK at the moment. I mean, at the height of the credit crisis on 14th of August, Thames Water issued 900 million pounds of bonds, and so quality assets, you will be able to finance even in this world. But the fact is, you are operating currently in a world where there's an inverted yield curve in the UK, and in Europe there's a normal yield curve, and that is a peculiarity of the current environment. So just because you can finance something, easily today doesn't mean that in 5 years' time you're going to equally be able to finance it on the same terms.
Neil, if I can, I think core to answer your question is infrastructure immune. Is sort of understanding what happens when there is a perceived credit crunch, and that is a flight to quality. So you see money flow to higher quality assets, and the classic would be US government securities or gilts. I think infrastructure is immune from the perspective that they're high-quality cash flows, but exactly as Martin and Olivier said, once you gear up the debt to buy those or you pay a perceived premium for those, you've turned what are high-quality, stable cash flows that would probably be somewhat immune into quite risky cash flows because of the financial engineering that goes alongside them, and then it will become less immune and fall more into trouble because the flight from quality will move away from those cash flows which have become more risky through the financial structuring back into higher quality assets.
You might want, sorry, I was going to say you might want to differentiate in the credit crunch between new projects and refinancing existing. On new projects, the great plus about project finance and infrastructure assets is they exude all the qualities missing in the problem assets in the credit crunch. And the whole point is that quite often on these deals, we can spend 2 years on some of these deals doing detailed due diligence, planning, costing, and understanding what makes them tick. So in a way, the crunch is just a little bit of noise going on during a 2-3 year horizon. So those assets, the fundamentals haven't changed. When doing a credit rating on them, they're as strong as ever. It is only when you're actually refinancing those assets or you're buying assets on the assumption that you're going to be able to increase your returns through a big refinancing at aggressive rates, and that's what you've bought a company and geared up against, and now you're finding that challenging. So it's that second class of assets which is suffering.
I heard from an infrastructure fund manager the other day was, is there too much infrastructure fund equity around to buy these assets? He said, no, there definitely wasn't. There was just too much stupid equity, which I thought was quite a good comment. And I think the point that we're all making is there was a credit crunch in August. It's working through now. Infrastructure assets are good quality assets. They throw off long-term cash flows. But you can make the funding structure difficult, risky, if you build in the need for a refinancing with an LBO-type structure in 3, 4, 5, 6, 7 years, or you could have a long-term project finance structure with a 20, 25-year amortization, which meets the cash flow profile, to the penny almost. And the